Okay, picture this. You open your mailbox, and sitting right there is a collection notice from the IRS. For most individuals and small business owners, it's just a uniquely terrifying moment, right? The bureaucracy feels completely endless, the rules seem opaque, and that balance due? It can look totally insurmountable. But what if you could look at that debt not with panic, but with the cold, calculated strategy of a seasoned tax controversy attorney? Well, welcome to today's Explainer. We're going to look at IRS installment agreements through the lens of a tax attorney, someone who has logged thousands of call hours with IRS collections personnel and resolved millions in tax debts. We're going to transform that intimidating IRS debt into a clear, logical, and manageable blueprint. Let's dive in.
Here's our roadmap for this explainer. We'll start by facing your IRS debt, compare simple versus non-simple agreements, explore the hardship path known as the PPIA, talk about setting up your payments, and finally, cover avoiding defaults and liens.
All right, Section 1, Facing Your IRS Debt. Now, the absolute first thing an experienced tax attorney does when a client walks into the office isn't to panic about the dollar amount. Nope, it's to look at the timeline. It's absolutely crucial to understand that the IRS does not have an infinite amount of time to chase you for a tax liability. They are actually bound by a very strict, legally enforceable boundary. That boundary is the CSED, or the Collection Statute Expiration Date. Let's translate this IRS jargon into plain English. The CSED is the literal expiration date on your tax liability. The IRS generally has a limited window of exactly 10 years from the date your tax was officially assessed to legally collect that debt. Once that date passes, well, barring a few specific events that can pause the clock, the debt is no longer legally enforceable. Knowing this date is the absolute foundation of literally any negotiation strategy. When we map out your options on a decision tree, the very first critical question, right after can the taxpayer pay in full is the taxpayer in compliance? This is paramount. If you have unfiled tax returns, the IRS is going to stop you right there. You simply cannot establish a meaningful agreement until all required returns are filed. Once you're actually in compliance, the paths branch out based on how much you owe. Specifically, if it's under $50,000 or under $250,000, and whether a revenue officer has been assigned to you. Your compliance status and your actual provable ability to pay strictly dictate the exact options you have available to resolve the balance.
Moving on to Section 2, Simple versus Non-Simple Agreements.
For the vast majority of individuals and small business owners, your tax debt is going to fall into one of two standard tiers of IRS repayment plans. The type of plan you actually qualify for hinges heavily on the overall size of your assessed balance. Let's compare these two directly. On one side, we've got the Simple Installment Agreement. This is designed for individuals who owe up to $50,000 or businesses that owe up to $25,000. Now, the real beauty of the Simple IA is that it generally does not require you to provide a detailed financial statement, and crucially, it generally prevents the IRS from filing a notice of federal tax lien. On the other side, we have the Non-Simple Installment Agreement for debts up to $250,000. While this one also usually avoids that dreaded financial statement, there is a massive catch. A notice of federal tax lien will be filed, and that lien is a public claim against your property, which can severely impact your credit and your ability to borrow.
These insider rules come straight from the Internal Revenue Manual. What I want you to notice here is the requirement for a Collection Information Statement, or CIS. That's a deeply intrusive Form 433 that details literally every aspect of your finances. For both simple and non-simple agreements, a CIS is not required. This is a massive strategic advantage. Unless there's a serious delinquency or a specific need to release an existing levy, these standard agreements let you set up terms to full pay your balance before the CSED, all without having to expose your entire financial life to an IRS examiner.
Section 3, the hardship path, known as partial pay agreements. But what happens when you simply cannot afford to full pay the debt before that 10-year expiration clock runs out? Well, this brings us to a highly advanced strategic option reserved for taxpayers facing severe financial distress. The Internal Revenue Manual explicitly outlines this path. It states that while all taxpayers are expected to full pay, if full payment cannot be achieved by the CSED and the taxpayer has some ability to pay, the IRS can enter into a partial payment installment agreement. So the absolute crucial point is this: the IRS legally accepts your current inability to pay the full debt, because forcing you to do so would create an economic hardship. An economic hardship is strictly defined as the inability to pay for necessary and reasonable living expenses. If you can actually prove this, you can essentially pay less than you owe until the debt completely expires.
However, and this is a big however, achieving a PPI is incredibly difficult.
Just look at the numbers. Out of over 1.8 million new installment agreements established in 2020, only 21,501 were partial pay. That is a staggering 1.18%, less than 2%. So why is it so incredibly rare? Well, because unlike those simple agreements we just talked about, a PPIA absolutely requires you to bare your soul financially. You have to submit a full collection information statement. That's Form 433. And the agreement has to get explicit managerial approval. The IRS is going to scrutinize your rent, your groceries, your car payment, the whole shebang, just to ensure you truly have no other way to pay.
All right, Section 4, setting up your payments.
Let's assume you've navigated the rules, and your agreement, whichever type it may be, is finally approved. How do you actually remit your money to the Treasury every month? You basically have 4 primary options. You can go old school and mail in a check or money order with a voucher. You can use direct debit. You can set up a payroll deduction. Or you can pay online via direct pay or the electronic federal tax payment system. Now, quick insider warning for you here. While the IRS does have an online payment agreement system to help set these up, tax professionals know it can be notoriously buggy. Relying on it blindly without verifying your setup can literally lead to missed payments.
If you take the direct debit route, you're going to be filling out Form 433D. What's absolutely crucial to know here is that if you are dealing with a local collections officer, especially if you have any history of defaulting on past agreements, they will almost always push you to use this method. Direct debit ensures the money comes directly out of your bank account automatically. It dramatically reduces the risk of human error, like simply forgetting to put a check in the mail, and it keeps you compliant.
Alternatively, there's Form 2159 for payroll deduction agreements. This is where your employer agrees to withhold a set amount from your paycheck and send it directly to the IRS, much like your standard tax withholdings. Now, while this is a perfectly valid and incredibly reliable way for wage earners to stay compliant, it is a surprisingly rare request. Neither the IRS nor taxpayers typically jump to this option first, mostly because it requires bringing your employer directly into your personal tax controversy, which can be kind of awkward.
Finally, Section 5, avoiding defaults and protecting your agreement.
This is perhaps the most critical phase of this entire consultation. Getting an installment agreement approved is a massive victory, for sure, but keeping it active, that's an ongoing battle. You absolutely must protect the agreement to avoid disastrous penalties. The IRS has strict deal breakers that will force them to instantly tear up your agreement and demand full payment, and you need to be hyper aware of them. First, simply stopping your payments after the IRS has made a demand to catch up. Second, failing to file a future tax return. Remember, compliance isn't just about the past, it's a permanent requirement. And third, filing a new return with a balance due that remains unpaid. Look, if you owe $10,000 on an agreement, and next April you file your taxes and owe an additional $500 that you can't pay, your entire installment agreement defaults. No exceptions.
And hey, if you are one of the lucky 1.18% who actually secured a partial pay installment agreement, I need to give you an extra specific warning. The IRS accepts your current inability to pay, sure, but they completely reserve the right to request updated collection information statements in the future. If you get a promotion, if your spouse gets a high-paying job, or if your economic situation improves in any significant way, the IRS can and absolutely will revise your agreement and increase your monthly payment. A PPIA is a living document, guys. It is definitely not a set-it-and-forget-it deal.
So we've covered a ton of ground today looking at all of this through the strict strategic lens of a tax controversy expert. From understanding the hard expiration date of your debt to choosing between simple, non-simple, or hardship agreements, you now have the attorney's blueprint. So I'm going to leave you with this final, empowering question. Knowing your exact collection statute expiration date and taking an honest look at your true financial limits, which IRS agreement are you going to pursue to finally resolve your tax debt and get your life or your business back on track? Thank you so much for joining me on this explainer, and I really hope this knowledge gives you the clarity to take action today.